Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some financial results that would have come out over the busy carnival period, and we're going to take a look today at NCB Financial Group as well as Agostini Limited. Both groups would have had varying fortunes. Let's take a look at how each of these stocks would have performed and what investors can expect in the coming months ahead. Turning firstly to NCBFG or NCB Financial Group. That group reported an earnings per share figure of just about 2 cents TT dollar equivalent, a fairly substantial 68% decline from the 5 cents TT equivalent reported in the prior comparable period, and that's for their first fiscal quarter ended December 2022. Net results from banking and investments encouragingly were up just about 9.2% from 1.08 to 1.18 billion. Overall net operating income, however, declined just about 12.8% from 1.489 billion to 1.298 billion on account of some weaker insurance operations results, and overall net profit attributable to equity holders declined at 68% for the first quarter from 115.6 million TT equivalent to just about 37 million TT equivalent. Again, over the comparable prior period, a 68% decline. Now, when we take a look at the net operating income by segment, it was generally good reading across most of the operating segments. Net interest income, for example, was up just about 4.7% from 713 million TT equivalent to just under 750. A net fee and commission income increasing just about 9% from 281 to 36 million in that yellow segment. The major mover, which would have led to that 12.8% decline in net operating income, as we can see, were the net revenues from insurance activities declining from 407 TT equivalent to just about 116 million TT dollar equivalent, and that would have been attributable in large part to a supposed one-off actuarial adjustment that would have had to been taken into account during this first fiscal quarter for NCB Financial Group. Now, from an earnings per share perspective, a trailing EPS perspective rather, investors would note that trailing earnings per share has continued to recover over the trailing 12-month basis despite that fairly weak first quarter result. That trailing EPS in green is about 49 cents per share TT equivalent, which compares favorably to the 25 cents per share on a trailing 12-month basis in the prior comparable period, or at the prior comparable period. And that combined with a fairly significant decline in NCBFG's trading price has brought the price to earnings multiple down from a very lofty 38.1 times to just about 8.9 times. To put this in context, pre-COVID, NCB was trading at a multiple of just about 14 to 16 times in terms of price earnings ratio. So it does appear that the stock is trading at a fairly significant discount relative to its own historical multiple. So at a price of $4.17, well, NCB is trading at that multiple of 8.9 times, which is fairly well below the sector average of 13.9 times price earnings multiple, of course, and it does not pay a dividend right now. The dividend yield on a trailing 12-month basis is 0% compared to the banking sector's average of 3%. So with those lower earnings in mind, some insurance operations, and certainly from an accounting perspective, in consideration, no dividends as well, but a relatively attractive price earnings multiple for those value-oriented investors. Bourse is going to maintain a market weight rating for the time being. Turning quickly to Agostini Limited, and well, for its first quarter of fiscal 2023, the group recorded an earnings per share figure of $2.11, a whopping 140% increase from the 88 cents recorded in the prior comparable period. Now, take this with a grain of salt. There was a fairly significant one-off gain on acquisition based on the report coming out from Agostini. When we take a look at some of the operating metrics, revenues were up 12.2% from 1.1 to 1.275 billion. Operating profits overall increased from 136 million to 157 odd million over comparable periods, and that net profit attributable to equity holders increased from 60.8 to just about 145.8 million. Again, this would have included a fairly significant one-off gain on acquisition for the group. When we take a look at profit before taxes by segment, again, a generally positive trend for Agostini Limited. Fast-moving consumer goods up just about 10% from 82 to 90 million. Pharma and healthcare up almost 30% from 38 to 49 million. And that very significant one-off gain likely falling into the industrial construction and holding segment from that 8 million to 84 million. When we take a look at the margin story for Agostini, it is, again, a very positive trend. The operating profit margin probably tells a better story of the group's recurrent performance, and that operating profit margin has, in that red column, has increased significantly and consistently over the past few quarters, increasing to 12.4% from 12% in the prior comparable quarter in 2023. That profit before tax margin, of course, somewhat inflated because of that one-off gain, rising from 11.3% to 17.4%. So at a price of $58, Agostini is trading at a price-to-earnings ratio of 14 times above the sector average of 11.5 times. That it may be a little bit higher when we adjust for that one-off gain, and offers investors a dividend yield of 2.2%, which is pretty much in line with the 2.3% sector average. So with revenue and margin growth in mind, continued acquisition activities of the group, which have proved accretive over time, but with watching that slightly elevated valuation from a price earnings perspective, Bourse is going to maintain a market rate rating on Agostini for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our website where all of our research is absolutely free at bourseinvestment.com. Stay safe, and we'll see you next week on the Bourse Report.